it all comes down to the fundamental nature of price. Price doesn't move randomly. It's a direct reflection of human psychology reacting to major events. This creates predictable, repeating shapes or patterns that we can learn to trade. This, in a nutshell, is basically how patterns emerge. And we are now diving into more detail what really drives the market. And to understand patterns, we must first look at the phases of the market. And price is constantly shifting between two distinct modes. Price is either in an impulsive phase or in a corrective phase. Impulsive phases, they are all about momentum. This is when the price moves strongly in one direction. You can see that here very clear. Price is moving far within a very short amount of time. And on the other hand, corrective phases, they are moments of doubts. That's when the market pauses or it digests a move. It basically builds here, accumulates volume for the next move, in this case to the upside. And understanding these phases and being able to identify in which phase price is currently in gives us as traders an edge. It allows us to anticipate potential price behavior and helps us to spot certain patterns. And that leads us to the trader's opportunity. Within these phases, price is always doing one of two things. It's either continuing a trend or it's reversing it. And understanding this continuation reversal dynamic at key levels is the foundation of pattern trading. Let's have a look at some examples, and we are starting with continuation patterns. Here is a very simple 3-touch bull flag continuation pattern. We can see here we have the impulsive move into a corrective phase here before we then continue with an impulsive move. And by understanding in what phase the price is in, we can anticipate the next move and prepare for an entry. So for example, here we could enter this pattern in multiple areas. So first we have an entry here on the 2-touch because the 2-touch is already a continuation pattern. Price could just continue early. In this case, it came back for a 3rd touch. So then the more obvious would be here, an entry in this area. Another option would be to trade this pattern on the breakout. Then you have here again, you can see it's even on the lower time frame, you see the same again. We have an impulse here. We go into a correction, another impulse. Then we turn around here. That was the first high of the pattern. Then we get the first base of the pattern, a second high, a second base. So this was already a continuation pattern. Then we have a 3rd one, and we come back one more time for the 3rd base before we then go. We have another option here. We have here, we break out with an impulsive move. You see here again on the lower time frame, we form a continuation. That's another potential entry here for then the next impulsive move to the upside. You can see here just in this small piece of price action, basically one pattern, one larger pattern, there's already multiple times the same repeatable behavior of price, which shows us multiple ways to take advantage in just this small piece of price action. Let's have a look on another example. Here we have a 2-touch continuation flag, but this is a bearish one. Here we have a bear flag. Again, we start with the impulse leading into the corrective phase before we then break out with an impulse again. Here in this example, price actually went after the 2nd touch. So that's why we discussed the potential entry on the 2nd touch before already. Here we even had an internal structure into the high. And understanding this price behavior means if, for example, we are here, price is hovering in this area, then we know we can wait because we already know, we are in a corrective phase. Chances are high, price will retest the high for at least the 2nd touch. So we have No FOMO. We are not involved in any trades down here. We wait until price retests the high reversal pattern, and then we would enter here on the confirmation. Again, even in this small piece of price action, we have multiple entries. We have, of course, the most obvious here. We have the breakout entry again, like we were discussing before already. We have another lower time frame continuation here. Again, you see this impulse going into a correction and another impulse again. There's so many opportunities to take advantage by understanding these simple market phases, just the nature of price, to know when we are in valuable areas to warrant a trade. Let's have a look on reversal patterns. We start again here. This is a standard 3-touch reversal pattern. We have an impulse leading into the corrective phase, and we leave the pattern again with an impulsive phase. This is a weekly time frame, a weekly pattern. So there's so many opportunities in the lower time frame to take advantage in just this piece of price action alone. We can see here we have multiple patterns. We had here a double top first. So keep in mind, again, this is weekly. So there is entries in this area for at least this part to take advantage. Then price came back up one more time, took out both highs. That's why we have here a 1, 2, 3 before it then committed. Then how did it reach the third high here? We have an impulse. We have here a corrective phase and then another impulse before we started to turn around. These patterns, like all of them, they can come in many different shapes and forms. So, and this is a very nice example because it depends on how your perception is trained. You might see different patterns. There is an argument for a head and shoulder, left shoulder, head, right shoulder breakout. There is an argument for a failed pennant pattern here. Price did not continue to the upside. It failed and break out to the downside. Or there's an argument for a wedge pattern. All these points are valid. And that shows how subjective technical analysis can be. That's not a bad thing. And again, we repeat ourselves over and over again. It's the same price behavior. Let's have a look how price just reached the first main high. We had an impulsive move. Then we have a continuation pattern here, corrective phase. Then again, we broke out with an impulsive move. Then we turned around. We came back up one more time. Then we failed to get the high and broke out here of the pattern to the downside. And again, here there's so many ways to benefit from just this small piece of price action alone. This is daily time frame. So we have here on the lower time frame, there's options to take a trade in this area with stop outside. There is even an option to take this continuation pattern on the breakout, which then most likely would have ended here in a break-even trade, still okay. Then we have here the option to trade the breakout from the right shoulder, or even the retest here with the V-shaped recovery. Then we have the final confirmed breakout. We have another continuation here. Again, you see here a corrective phase, continuation pattern before we then continue. There's so many different ways to trade these patterns. And that's what makes the overall pattern trading so fascinating. So let's have a look on the chart. We were talking about the nature of price and that price is always moving within two phases, either in an impulsive or in a corrective phase. We are now here on the Euro-US dollar chart on the weekly time frame, and this is a blank chart. We will just have a look how price is really moving and if we can spot this type of behavior on any chart. We are choosing Euro-US dollar because it's the most traded forex pair, and I'd like to stay a bit on one pair because it is easier for you to then recognize and maybe remember some patterns which we will discuss later in follow-up sessions again. We will start here in the area of the euro introduction. The euro got firstly introduced as an electronic currency in 1999, so that's somewhere in this area here. and then we had it introduced as a physical currency in the 1st January of 2002. So let's see if we can spot this market behavior already on historical data. And you can see here in the first glance that we had here already initially a first impulsive move, then we came into a corrective phase here before we then continued with an impulsive move. And this is like a classical continuation pattern which we discussed before, and this is on the weekly time frame, keep in mind. So, and you can already see that if we drill down and we just have a look on this overall leg here, for example, we can already spot that the same happens within this higher time frame impulsive move. We have here a first impulsive move, we are then again in a corrective phase and have a continuation pattern, and then the next impulsive move. So this is basically the same like we had here, just on the smaller scale. And then even here, you can see the same behavior again. We had it an impulsive move going into a corrective phase before we then see the next impulsive move to the upside. Basically, price is only in two different kind of phases. You can argue that this was here one larger impulsive phase, then we had here a longer corrective phase before we then had another impulsive phase, which then ended again in a corrective phase, finishing with the next impulsive phase and the corrective phase. And as you can see here already, there's a tendency that these corrective moves here, they last longer. So the majority of time we are in the market, we are in these corrective phases. So that means for us as traders, we have to become comfortable in trading within these corrective phases and not only be able to make money in these impulsive phases. Of course, it's much easier to make bigger trades in these impulsive moves because price is just moving in one direction, but we have to be able to capitalize on both of these phases. And as we discussed before, here that's the start of the euro, and the past data you see here, this is basically the Deutsche Mark that time, which is used here as a benchmark because that was the biggest European currency before the introduction of the euro. Let's go back to the start of the data collection here on this chart. That should be somewhere in 1970 something. And you can really see it's even that time we had the same behavior. We have here an impulse. We have a small correction. We have an impulse again. We are in a more corrective phase. We have an impulse again. We end up in a corrective phase here. That's a reversal. Another impulsive move. Here the same. That's a longer corrective phase here before we then have another impulsive move into a correction, into an impulse. Same way down. Impulse, correction, impulse. So you can see it's really always the same behavior, and that goes back since the beginning of trading, basically. Because we said before that these patterns overall emerge from human psychology reacting on major events. And what these major events are, that's something we will discuss a little bit later. But let's just stay here on a bit more recent data and go down to the daily time frame so that you can see it a bit clearer and how much opportunities we have here in the market. We can pick an area here after year 2021, because here we can see we have a very nice impulse, a correction, another impulse, another correction, ending up in an impulsive phase. Then we have here this head and shoulder pattern. That's a pattern you might recognize from before. That's the one we discussed on a few slides before. Then we had the breakout, another correction, another impulse, another correction, another impulse, another correction, another impulse, and so on and so forth. Same here. This is also a pattern you might recognize from before. This is this 3-touch reversal pattern, an impulse. Then we have here a larger correction with another last leg impulse, correction, impulse, and here the 3-touch reversal pattern before we then have the next impulsive move again. And within these runs, when we are able to identify the phases we are looking for certain patterns. Let me shortly clean everything up here. We are still on Euro US dollar on the daily time frame. And you remember here, I'd like to stay on this piece of price action after this larger here reversal pattern. And after a reversal pattern, we are expecting the next impulsive move, in this case, of course, to the downside, and therefore we would look more for continuation patterns. And I'd like to show you what type of entries, pattern entries, we can trade just on this small piece of price action here between what's that? That's like August 21 and something like April 22. We just pick this. And we can pick any piece of price action. It's all the same. So we don't identify every single potential trade. We stick here to the 4-hour and we just have an overall look to get an idea how dynamic the overall pattern trading system is. Let's start after the confirmed breakout. However, you want to confirm the overall reversal pattern. So the majority will probably see it confirmed after this V-shape recovery, the retest, and then the sell-off here. That's the first really confirmed impulsive move leading into a correction. And so let's, for the sake of simplicity, let's just start here. And then we can see that this normal type of patterns, they are repeating themselves over and over again. Again, keep in mind here, we are on the 4-hour time frame. So of course, there's a lot of lower time frame trades, even just in this first continuation pattern here. The price left here a small liquidity area. We have here the back end of this previous low here to the left. Then you can see here we have here an impulse, another correction, an impulse for the middle section of the larger 3-touch structure. So that's, for example, an entry you can take here for a counter trend trade on the lower time frame, or then you go with the trend. What we are looking here now is mainly to trade with the trend to see the bigger moves here. So that would then mean we wait for a 1, 2, 3 structure. So we have here then the second touch and the third. So this here would be the entry signal for us in the higher time frame trade. So that's another potential entry. Then we have here another continuation pattern in form of a 2-touch. So this is a bit more advanced, another entry, or then a scale in. This overall piece of price action here, this is an overall corrective phase. So we had here the impulse, then the correction, the next impulse, and in the next impulse, a very small momentum entry. So that would be a breakout entry here. Another bear flag into the next impulsive move, of course. Then price left a small liquidity area, which we see very often. Price is coming back up, tapping them, form of a V-shape recovery. That would be another entry. After this impulsive move here, we would expect some form of correction. So we get that here. The market takes a breather, is accumulating more volume, tapping this small liquidity area here to the left before then starting to aggressively sell off. Here again, a momentum entry, another bear flag. Then we had here a bit of undecided, a bit more advanced running channel entry into a flat flag, another entry. And these are really just standard bear flag continuations. So overall, you can see, just to get an idea about the price nature, it is really always the same behavior. It's always, price is constantly changing between an impulsive, more momentum, aggressive moving into a corrective phase where price takes some time, like basically digests the previous move, accumulates volume for the next move. And this is a repeatable behavior. And by knowing that and identifying where we are, we can train our perception to wait for a certain type of patterns. So that's basically the nature of price. We had now quite a detailed look at the nature of price based on the Euro-US dollar chart example. But what truly triggers these large shifts from one phase to the next? It's not the chart, it's the market drivers themselves. And specifically in Forex, 4 main drivers create these overall market phases. We have the economic health. That's the health of consumers. And since the consumer spending is the largest component of GDP, a healthy consumer sector is crucial for an overall economic growth. The health of consumers is directly tied to the strength of a country's currency. Then we have the monetary policy. That's basically central banks. And central banks significantly influence the currency rate with usually their interest rate policies. And that's why interest rate decisions and publications from central banks are always considered high impact news in the Forex market. Central banks hold a dual mandate with the goal of maximum employment and control of inflation, that's price stability. And therefore they can directly interfere in the markets and manipulate the value of their domestic currency to support their overall mandates. Then we have the government spending, fiscal policy. In the Forex market, government spending refers to the total amount of money spent by the government on goods, services, infrastructure, defense, and transfer payments in terms of, for example, social security. Government spending is a tricky one. It can affect the currency in 2 primary, often conflicting ways. For example, if the government increases spending on building roads or infrastructure into the economy, this is a form of economic stimulus. This spending boosts the demand, leading to higher employment, higher incomes, and then overall a stronger GDP growth. This leads to economic growth and can lead to higher inflation, which often then prompts the central bank to raise interest rates. And of course, that's bullish for the currency. However, if this government spending is funded by borrowing money, that can lead to concerns about the government's ability to pay it back. And this in turn can lead to a loss of confidence. And if foreign investors lose confidence in the government's fiscal stability, they may sell off their holdings. That would then lead to an overall bearish impact. And then, of course, we have politics. In the Forex market, political stability refers to the predictability and reliability of a country's government, the legal system, and the overall policy-making environment. That means a stable political system is crucial. It ensures that the rules of the games, like taxes, regulations, property rights, debt obligations, they are unlikely to change drastically or, more important, unexpectedly. For example, confidence encourages long-term capital inflow. To invest in a country, foreigners must buy the local currency, leading to an increase in demand and an appreciation, which therefore is bullish for the overall currency. These, in a nutshell, are the main 4 drivers or the pillars of a currency. Another factor not to underestimate is the speculation of investors based on the perceived outcome of these events. So before we spoke about the 4 pillars of the markets. Now we are talking about the biggest players in the market. And by far the biggest players in this field, in the speculation field, are the investment banks. They deal on the interbank market, they trade between themselves or on behalf of large clients, like usually pensions, hedge funds, large corporations, or even governments. This interbank market represents by far the largest volume of traded currency in the Forex market. And another large player in terms of volume after the investment banks and the central banks are the hedge funds. They usually trade aggregated capital from investors, and they seek actively to outperform the market. And then, of course, the speculation also includes the millions of retail traders who participate in the markets. And even though the number is in the millions, their overall traded volume is very low compared to the institutional investors. And this collective speculation is what creates massive fluctuations. And yes, this speculation creates the pattern we are looking for. So we are back on the Euro US dollar weekly chart, this time with a slightly different focus. We discussed now what the major drivers are. We have the governments, the institutions, they trigger events, and then we have the speculation and the interpretation of the impact of these events that leads to repeatable behavioral patterns. And that's why pattern trading is so effective, and it's the same since the beginning of trading. Of course, overall the markets evolve, the patterns evolve, you have to trade them slightly differently, but overall this is always the same interaction between these different stakeholders in the market. And yeah, let's have a look on some events and what it means and why certain events have a higher impact than others. So we will not discuss every single one in detail. You can have a look at these events yourself. But of course, some major events shortly before the introduction of the euro as a physical currency, we had the September 11 terrorist attacks. And of course, after these terrorist attacks, we had a global economic uncertainty. And you can see here, after this corrective reversal pattern, we had this impulsive move in a correction and in a next impulsive move. And then the next impulsive move was basically confirmed again here. At this time, more or less, the move was finished. We had a 1, a 2, and a 3. And then here was the decision making. We tapped into an area of interest to the left on historical data. And that's now a level, however you want to call that, right? Every system has some other ways of describing that. We just say here, this is a historical area of interest. And now we need some catalyst to tell us if it's either reversing or continuing in the longer time frame. We are talking here on weekly time frame, right? And then in March 2003, we had the Iraq war, and that in turn caused some rising in oil prices and impacted the global overall market. And the US dollar got weakened due to the war cost. There were concerns over US military spending. And with this start of a war, which is a very big uncertainty, so we know that the next, or it's a higher likelihood, the overall speculation was on the side of a weakening of the US dollar. So that's why the euro continued further to the upside. And this pattern here became a continuation pattern and not a reversal pattern. Then this goes on for quite some time. Then we have standard behavior. Another news event was here in December 2007 when the European Central Bank announced a rate hike. Then you can see here as well, we had this impulsive move leading into this corrective phase where the market was waiting what the ECB will do, what is their decision. And then we had a rate hike. So that, of course, made euro more attractive. And we had the next impulsive move to the upside. So we had here again, it's an overall finished move. We had a 1, a 2, and a 3. An impulse, correction, impulse. And then here we had a turnaround. We had here a reversal pattern on top. And the big October 2008 Lehman Brothers collapse. And that triggered the global financial crisis, leading to a flight to safety. And then here we had November 2016 with the US presidential elections. Initially, there was an anticipation of pro-business policies and tax reforms. So you had an initial sell-off in the euro, then uncertainty, so a strengthening in the euro again against the US dollar. Then of course we had this longer, more corrective phase into the COVID pandemic in March 2020. Then we had here in July 2021 the US recovery signs. We had strong economic data, and they showed that the recovery in the US post-COVID-19 seemed much stronger than in other countries. And that, of course, led to a continuation of euro sell-off. And then here we were already in an impulsive move and further weakness in the euro US dollar. And then we had this unexpected catalyst of February 2022, the Russia invasion into Ukraine, which of course led to a further fairly aggressive sell-off in the euro against the US dollar. And then we had here in October 2022 the US interest rate hikes, and that's a very nice example. You would basically expect for a further sell-off, but this was a rate hike which was already fully priced in. So you have some scheduled events, central bank statements, they are set on the calendars. Investors are waiting and are already anticipating these moves before. So that's why this rate hike was already priced in. You did not see a further continuation in a sell-off in the euro. Instead, we had this as the catalyst in the opposite direction for an appreciation in euro US dollar, which then got confirmed with the March 2023 rate increase. And that was the last leg into this larger reversal pattern we discussed then before. And yeah, now we are basically at the end of the overall timeline. So this is just an example of how these major events impact the overall flow of money. They impact the overall directional moves, the anticipation of certain events and the interpretation of these events. This is speculation, and that then leads to these repeatable price action patterns. This interaction between these major events, the psychology of the market, I think it's really fascinating and makes pattern trading one of the most versatile systems overall. We just discussed the weekly time frame and daily time frames before. I mean, down to the 4-hour time frames or more on a swing style, and then you can go down to the 5-minute time frame and trade on a daily basis, and you will find exactly the same patterns, the same overall nature of price on the lower time frames. So overall, what edge do we have with pattern trading? I mean, in general, you can just solely focus on technical analysis. That's totally fine. It's more than enough, and you can be hugely successful by just trading technical analysis without incorporating any fundamental news or whatsoever. But this approach is a bit limited. If you're just trading on a daily basis within a daily price range, technical analysis and pattern trading on the lower time frame is more than enough and can be hugely successful. So the importance of understanding fundamentals and these market drivers is really crucial if you want to trade slightly higher time frames. If you want to trade daily time frame up, then there is no way around at least a basic understanding of fundamentals and this interaction between the market drivers and overall psychology. And then, of course, as automation and AI trading grow, integrating fundamentals into your strategy is crucial for maintaining an overall competitive edge. Because even if all these 100% technical systems are replaced by AI automatic trading, systems which are trading higher time frames and allow some form of discretion, which pattern trading obviously does, will still be profitable. So to sum things up, gaining an edge in trading involves combining the technical analysis with an understanding of market drivers and fundamentals to maximize opportunities. And I truly believe this helps us to adapt to evolving market dynamics, especially now in the time of AI trading. So we have now reached the end of part 1, why price patterns always emerge. And if you enjoyed this video, please like and subscribe and stay tuned for part 2, where we will dive into the more technical aspect of pattern trading. And let me know in the comments what systems you trade and your main takeaway from pattern trading, and maybe whether you plan to incorporate some of these aspects into your own trading strategy. Thanks for watching and see you next time. Bye bye.